If there's a specific product that has given us a very bad reputation in this country, is the endowment or education policies. This is why I keep on saying that lack of understanding is the beginning of your downfall. So today I challenge you to forget everything you think you know about life insurance, endowment policies, pure risk policies, so that we can start this conversation on a new slate. My name is Mnyindo, as the founder of La Risk Africa, where we focus on the protection and preservation of family wealth. And if you have not yet subscribed, please, this is the time to go to the subscribe button and do it right now. And don't forget liking and sharing it with someone who you think will be benefiting from this whole conversation. Kenyans, we need to talk. We need to address this elephant in the room, because I do know there has been a lot of conversations around life insurance and endowment policies, especially. Because the one thing we realized after doing so many reviews over the last number of years is a lot of you don't even understand how these endowment policies work. Most of you are coming from a place of, you know, this thing has burnt me. I hate how these endowment policies work. And it is understandable where it is that you're coming from, right? But the other thing we realized, a lot of you are also buying a lot of these products without fully understanding what it entails. And you also don't know what are the other alternatives in the market. Endowment policies for the longest time have been almost like a rite of passage. The time it is you finish, your university, then you get your first job. Most of the time what usually happens is when you are seated in the office, there's an insurance agent who comes around and starts having a conversation with you and like, oh, there's these policies that you can get, usually either an endowment policy or they call it an education policy. And they tell you that this is a good place to start your savings journey, right? And the reason why we say we have to have this conversation is you have bought these policies, and a lot of you, it's year 3, it's year 4 down the line, your knowledge has increased, especially when it comes to matters investing, when it comes to matters insurance. And when you look back into what it is that you have, you realize that this is not what I actually wanted. This is not what I thought I was signing up for. But most probably because of the pressure that could have been coming from the agent or your lack of knowledge during that season, you buy this policy, then you realize it's not for you, then you just end up canceling all things insurance, right? I think if there's a place or if there's a specific product that has given us a very bad reputation in this country, is the endowment or education policies. This is why I keep on saying that lack of understanding is the beginning of your downfall. So one of our biggest goals, especially when it comes to this series, because it's going to be a 4-part series, is for you to understand endowment policies as they are, to know how it is structured, how exactly it is that it works, to know the advantages, to understand the disadvantages. And if it's something that is not for you, do you know what is the alternative when it comes to now planning your investing or your protection journey, so that even as you're making this decision, you're coming from a place of knowledge. So what exactly is an endowment policy? An endowment policy is a life insurance policy with a savings element. So how exactly it works is that you pay this product for a period set of time, right? So you're like, okay, I want to take this for the next 15 years to educate my child. So if something happens within the 15 years, there's going to be a payout. So when I say if something happens, that means death, a disability, or critical illness, depending on the type of cover it is that you have. Or at the 15th year, if you have made sure that all the premiums have been paid, everything is good, all the loans have been paid, you are going to get a lump sum at maturity or how some policies are structured, especially education policies, is upon maturity, your children start receiving an amount of money every single year to take care of their education. What are endowment policies mostly used for? Because again, endowment policies are the most popular policies currently in the country. And as I'd mentioned earlier, it almost feels like it is a rite of passage. By the time it is that you're done with university, going into your first job, this is most probably the first policy you must have encountered. So this is what most people use these policies for. There's first education planning, because most parents want to know that in the case something was to happen to me, my children can be educated no matter what. So you sacrifice and put aside this amount of money every single month. And then upon maturity, this money is going to be paid out so that it can take care of your children's school fees. Or even during the period of time that you're contributing and then something happens in between, there's going to be a certain level of payout and an amount is going to still be paid for your children's education. There's some people who also use it to save for big purchases, like let's say you're saving up for a home and you just also still same criteria. You put this amount of money every single month for the next 15 years, 20 years, and you get this lump sum to help you buy this home. Right? And then something else, sometimes people use it for retirement planning because they also want to ensure that they do have a lump sum upon retirement, and others just save for the sake of saving. So I don't know what category it is that you fall in, but remember, endowment policies are life insurance policies with a savings element. So how exactly are endowment policies structured? I think that is a very important place to start so that you do understand the in and out of the product, so that even as you're making your decision, even as you're moving forward, you're coming from a place of knowledge. Most of you, all you know is that, okay, I'm contributing 10,000 shillings for the next number of years, and this is the amount of money that I get in the end. So how most of the time this policy is presented to you, especially maybe when it comes to a salesperson, they say, okay, you just need to put 5,000 a month for maybe the next 10 years or the next 15 years and you get 600,000, right? That's all you know. But now we want you to know and understand fully how exactly their policy is structured. How is endowment policy structured when it comes to, is there a part of it that goes towards a pure life cover? Is there a part of it that goes towards a savings? Because we've mentioned that this is a life insurance with a savings component. So if you're contributing that 10,000, that 20,000, that 50,000, where does your money go? And another reason I have to address this is because a lot of you feel that there is lack of transparency when it comes to buying these endowment policies. So your insurer tells you, just give me this amount and I'll do what it is that I do with it. So you just know the end goal. You just know that in the case you're to pass away, your family gets X. In the case now you are to live the whole term and you reach maturity, your family gets Y, right? So when it comes to how these policies are structured, when you're contributing that premium every single month or you're contributing that premium every single year, that portion, a bit of the portion of the premium goes towards now a pure life cover. I have been able to talk about this in some of my previous videos on how pure life covers work, and please check now the description box below for the link towards that video. So how pure life covers work is you make a contribution to this life cover, right? And then in the case of a death, disability, or critical illness, there is going to be a lump sum payout. Yeah? Are we together there? And then part of the premium, right, also goes towards now the savings element. So this is taken up by the insurer and they decide how they're going to invest. Because remember, you have given them all the control. You just told them, you take my money, give me the protection, give me the investment or the savings, and then at the end of the day, this is the contract we have, this is the agreement we have, this is the amount of money I am expecting at the end of the day. So remember, one portion goes towards the pure insurance so that it can take care of the death, disability, or critical illness aspect, and a part of it goes towards the savings element, right? And when it comes to insurance and investing or savings, again, it's important for you to understand what is the difference between the three, right? As we said, life insurance to protect, savings is now putting money over a period of time for a specific goal, and investing is meant to grow your money and multiply your money over a period of time. We also have a video on the difference between saving, investing, and insurance, so we're also going to link it down below in the case now you need to understand it further. Right? So again, remember, for every premium that you're paying to an endowment policy, part of it goes towards life cover, part of it goes towards saving, the rest goes towards management fee, right? The only thing that you may not know is exactly how the insurer is apportioning all these premiums. You cannot tell exactly how much is going towards life cover. You cannot know exactly how much is going towards the savings, right? That's why, again, a lot of you sit down. The moment it is that now you have a bit more knowledge when it comes to investing, a bit more knowledge when it comes to insurance, and then you go back to your numbers, you're like, the math is not mathing, right? And we're going to get down into it on why sometimes this is so. You can be like, I've been contributing this for this period of time, but the return is not making sense. This is why it's important to understand that, you know what, an endowment policy is not an investment plan, right? It can be an investment towards your life or your kid's life, but it's not structured to be like an investment. You cannot look at an endowment policy side to side, say with a bond, because an endowment policy was structured to protect your savings. So remember, even when you think about savings, the money is not going to grow at the way you expect an investment to grow, right? So an endowment policy is, again, a protection product with a savings element. And this is why, as I said, a lot of you are finding it quite difficult to understand how it is that it works, but we're going to go deeper into it. Another one important thing that I have not mentioned that is important to know is, in as much as, yes, there's the different allocations of the premiums, your savings is attached to, obviously, the life cover, they're all under one roof. So even if you were to get stuck, you will not be able to pull out your savings element just the way you pull it out in a money market fund. This is why it's also important for you to be very clear on why you want to go down this road, because in the case, say you are to lose your job and you want to access the savings part, it might not be very easy. Again, this is why a lot of you have a lot of beef with the industry, and especially when it comes to life insurance. Because I remember there's so many videos that I've watched and so many people have spoken to, especially by doing our reviews. People have been contributing for a long period of time. Then you realize this is not something it is that I want. This is not something it is that I thought that I was buying. So you want to pull out your savings part, but the insurer tells you, okay, if it's been below 3 years, they tell you cannot even access anything. It means you cannot even get any single cent of your money, right? In as much as, yes, you've been contributing, say, for 2 years, 2.5 years, you cannot touch this money. And then also, even if, say, it's been over 3 years, even if you try to pull out this money, you might not get the full amount of money that you have contributed, because remember, first of all, you had a contract with the insurer. You agreed that I'm going to contribute for the next 15 years, and you're breaking that contract prematurely. And secondly, most probably the insurance company has not made its money yet. I'm giving you what is happening in the background, right? So you've said that you're contributing this money for 15 years. Remember, they have had to put quite a bit of money to also manage this policy. So chances are high they've also not been able to make their money yet, and you're trying to pull away the money prematurely. And then also, the reason why a lot of you have taken it is for disciplined savings. So they're trying to discourage you from pulling this money out, because if you are taking this, say, to educate your children, and then you pull it out prematurely, that means that you've not been able to reach that goal. Again, this is why it's important to note that we don't end wrong, we start wrong, right? Most of us don't understand from the very beginning. Our goals are not very clear from the beginning. We don't understand how it's structured from the beginning. And then the time it is that this thing is not working for us, you try pull it out, you're not able to pull out, or you end up losing so much of your money. And then, that is where now the bad feelings come up. But it's just because of lack of understanding. What exactly could be the reason why a lot of people take up these policies, the endowment policies? First, we have the convenience, because it's two products under one roof, right? There's it's protection element, which is the life cover, and there's also a savings plan. So if you don't want to go through the trouble of splitting and saying, oh, I'll protect by myself, or I'm going to now save by myself, you can just be putting aside one contribution, so you hit two birds with one stone, right? Number two, there is the guaranteed maturity. Because remember, this is a very conservative way of saving, and you are assured a certain amount at the end of the day. So for people who don't like taking that much risk, they just want to know, if I'm to put this amount of money aside, I am assured to get X amount, right? And by that, it just gives them that peace of mind that at least at the end of the day, I'll get the amount of money that I've been promised by the insurer. Yeah. And then thirdly, it encourages disciplined savings. Because the moment you think of trying to pulling out that money and you can't, or if you pull out that money, you're going to lose a lot, it will force you to be disciplined in your savings. So a lot of people, because again, to each their own, who feel that they do not have the discipline to put aside money, or you think, if I was going to put this money in a money market, by month 3, I would have pulled out everything and eaten everything, and my children are not going to go to school. Yeah. So for those types of individuals, sometimes they opt to go down this direction because they know that it will force me to put this money aside, and at least at the end of the day, there is an amount of money my children are going to get. So again, those three are the main reasons that most people take. And there's the people who are like, I just have extra money, I don't know where to put it, so I'm just going to put it in this policy. Very dangerous, but again, it's also a place that you can be able to put your money. Other benefits include the tax relief, right? If you have an endowment policy, we usually have a tax relief of 15% of the premium to a maximum of 5,000 shillings per month. So that's an advantage. Anyway, it is that we can save on taxes, we're going to go for it, right? And another advantage, which we've not spoken about, is being able to access loans. Because remember, this endowment policy has a savings element. So usually the insurer can give you, again, depending on the insurer, because every endowment policy is structured different. So it's important to know how yours is structured. You're able to get up to 80% of what we call the surrender value, or the cash value of your endowment policy. So if, say, you feel stuck, yes, you might not be able to pull out your money, but worst case scenario, you are able to get a loan. So we have spoken about the advantages, or why people might choose to get endowment policies. And one of the main reasons is, the convenience. But at what cost? Right now, I want us to go deeper into the disadvantages of endowment policies. And I'm going to talk about it from the perspective of the clients it is that we've worked with, and the different policies it is that we have reviewed. Right? Number one, we have the low returns compared to investments. So if you're someone who got this endowment policy for the sake of growth of your money, it means that whatever it is that you're going to get from an endowment policy cannot match whatever you would have gotten if you directly invested in an asset class, like maybe whether it's real estate, or putting money in a bond, or even mutual funds. So when you compare the returns and your goal was growth, whatever it is that you're getting here is not going to make sense. Because remember, when you're sending that money to the insurer, when you're contributing that premium, part of it goes towards life cover and part of it goes towards the actual investment. So it means that there's only a fraction, which you don't even know what is the fraction that goes towards the investment and what fraction goes towards the insurance. So if you're looking at it from a growth perspective, this is definitely not it. The second disadvantage is the high premium cost, especially if you're looking at it from an angle of protection. If you're going to compare protection from an endowment policy and a life insurance, a pure life cover. Let me give you an example. If you wanted to take a 15 million shilling cover, you want to know that in the case life was to happen, my children are going to be paid 15 million shillings instantly, right? If you're to buy an endowment policy, most of the time it is 5 to 10 times more expensive towards getting a pure life cover on its own. The reason why it's 5 to 10 times more expensive is because of the savings or investment element. You can see how this thing is playing out. The first part, we're saying you're not getting a good return because part of the premium has to go towards the protection. In this part, we're saying that the premiums for the same level of protection end up being higher because part of the money has to go towards the investment. So when you choose to go down the protection road and you say, all I'm looking for is a replacement of income in the case of a death, in the case of a critical illness, in the case of an accidental disability, going towards the route of the pure life cover is going to be so much cheaper compared to doing it through an endowment policy. And what it is that I'm going to do for you, even at the description box below, I'm going to show you the numbers so you can be able to compare side by side how exactly these numbers are reflected when it comes to now putting this premium aside and how much it is that I have to pay for, say, a 15 million level of protection through an endowment policy and a 15 million shilling worth of protection towards a pure life, which could be either term life or a whole life. Number 3, which is something that I also take personally, is the lack of flexibility, right? Insurance policies, especially now the endowment policy, do not give you that flexibility to move with the changing times. Let me tell you, one part that has made a lot of Kenyans angry is you have lost your job, right? You've been paying these premiums over a period of time. Now you can no longer pay these premiums because you don't have a job. But you cannot stop paying this insurance policy, right? Because it has been written that you have to pay every single month for, say, the next 15 years. So you remember, 15 years is a long time. Even 20 years is a long time. Something could happen in between and you can no longer contribute as you wanted at the very beginning, right? Yes, you could have started in a good place, but nobody knows what could happen in the next 5 years. So you stop paying these premiums and you might end up losing your policy completely. That means, yes, you will lose the life part, but you'll also end up losing your savings part, especially if you wanted to withdraw or you cannot pay anymore within the first 3 years. And even after the first 3 years, the most that you can get is a level of surrender value that might not even be making sense. So that lack of flexibility compared to, say, if you are putting this money in a money market fund, if you are to lose your job today, you can still continue, the money can still continue growing and you stopped contributing. You can literally put a hold towards this contribution, and then when you go back and you have more money, you can continue from where it is that you stopped. So again, lack of flexibility. Fourthly, something that touches so much the millennials and the Gen Z, which is lack of transparency and complexity. Because I had mentioned how when you contribute a premium, part of it goes towards a life cover and then part of it goes towards an investment. And when I talk about lack of transparency, you cannot tell how much has been allocated for what, right? You literally have just trusted this insurer. You're like, take my money and you do what you will with it, right? So a lot of you have been asking us, so what exactly do they do in the back end? How much exactly do they invest for me to get such a low return? Because it doesn't make sense, because when you look at it, if they're to invest it in bonds have a good return. If they even to invest it in a money market, it has a much better return. And also when you look at it from an angle of protection, why is the protection not as much for this level of premium? It's because you cannot really tell how they have allocated the funds there in the back end to take care of your protection needs. So the complexity of the structure, the lack of transparency of the structure can be a big disadvantage and does not sit well with a lot of people. Number 5, we have the low surrender value. If you choose to exit this policy early, the amount of money you're going to get as surrender is going to be so much lower compared to even the premiums that you have contributed. That means the person it is that has been doing these contributions over the long period of time will end up going to a loss. Number 6, we have the long lock-in period. When you're taking an endowment policy or any type of life cover, right, you have to remember you have to be consistent within the period that you have chosen. If you said you're going to be paying this premium for the next 20 years, you have to stick to those 20 odd years, or if it's the 10 years. So because of the long lock-in periods, it means that if for any reason you need liquidity, you're going to get stuck. Because for you to be able to access the money, you have to wait till the period is over. This is why, again, a lot of people get a bit of a roadblock when it comes to these policies, and they're at a place where they really need liquidity right now. We're going to tell you, for those people who choose to go down that direction, please don't do it, without an emergency fund, right? But we're going to go deeper into that later. Number 7, we have the inflation risk. The endowment policy might not be able to outpace inflation rates, right? So that means the amount of money you'll eventually get at maturity would have been eroded by inflation. It will not necessarily be the real value because, again, over the period of time, the funds have been eaten by inflation. Because remember, if this endowment policy of yours is growing at a rate of around 4% per annum, I've even seen some which go as slow as 2%, and inflation is at 6-7%, that means that even if you get that amount of money as a lump sum, yes, it is something, but if you had put that money somewhere else, you would have gotten such a much better result. And last but not least, unsuitability for protection needs. If your main goal was to protect your family, this policy is so expensive compared to getting a pure life cover, right? Because for the exact same premium, you will get a much lesser protection with an endowment policy compared to, say, a term or a pure whole life cover. Because remember, with endowment policy, it's combining two products at one, two goals at one, which is trying to do a bit of growth and trying to do a bit of protection. But if you really, really wanted to protect and you want a small amount, contribute a small amount for a big benefit to minimize the cost and maximize the benefit, the best place to be is just having a pure life cover. So we have looked at the reason why someone might get an endowment policy, and we understand because, again, we are not all built the same and we have different goals, and it's also important for us to understand ourselves, how we are when it comes to discipline with money, how it is when it comes to our knowledge with money. Do we have the capability of investing? Because, again, yes, we could get this money on the side and you have all this money open, but when it comes to your investment journey, you are left with nothing, right? So we've seen the advantages, we've seen the challenges with the structure. We have even gone deeper into the disadvantages of this structure. So now what next, right? So you're in this situation. You maybe already have an endowment policy. It's been maybe 2 years down the line. It's been 5 years down the line. Now you are getting the knowledge. The math is not mathing. Or you're looking at, okay, I wanted to get a plan where there is protection and there is growth. So what exactly am I to do in this situation? Now, in the next video, we're going to talk about how you can move forward if you want to change or you want to transition into a different plan. Because with this one, you are giving the insurer the power on how they're going to choose your protection and your investment. But if you're someone who are looking for something different, you're looking for an alternative plan, please join us in the next video in our series. And don't forget to like, share and subscribe to our channel so you don't ever have to miss any of these videos. I'm looking forward to seeing you.